Okay, welcome to the Chapter 9 Ratio Analysis presentation lecture. To give a little bit of an introductory as well as calculation techniques as on top of how these ratios can impact and show the success or downfall of a particular organization. All right, so before we get into ratio analysis, let's first talk about what it is. It is a comparison of two amounts on a financial statement and the evaluation of the relationship between these amounts. Now, between these different values, this is going to help determine, in terms of a CEO or a CFO or any type of upper management, the financial strength, the financial activity, and the debt paying ability, which can also be translated, if it's a publicly traded corporation, into whether or not this is a low risk investment, thus being attractive to future investors. Profitability ratios, these are the ratios that are used to evaluate the earnings performance of the business during the accounting period. These are going to be numbers that we will be taking off of the income statement, because the income statement is what determines whether or not we have a net income or a net loss. If we have a net income, we are profitable. So profitability ratios are going to help us determine our ability to grow, as well as our ability to continue to earn revenue. One of the profitability ratios is return on sales. Now, when we get to class next time we meet, we are going to watch the Investopedia video in class, and that's going to help us in determining one of the profitability ratios known as return on sales. Return on sales is a calculation that is done by taking our net income and dividing it by our sales. That is going to give us the percentage of what we get for return on our sales. Return on sales is a portion of each sales dollar that represents profit. So you want the return on sales to increase from the previous year. So that would encourage growth. That also is going to encourage increased revenue, as mentioned on the previous slide. Other profitability ratios that, or I should say other reasons that these profitability ratios are useful, is if we do have a return on sales that is increased from the previous year, this is what that might look like. So for example, in 2013, Roadrunner had a net income of $11.50 and sales of $26.50. In 2014, they had an income of $27.50 and sales of $5,000. Is their return on sales increasing, decreasing? And the question then being, is this good or is this bad? So go ahead and do the calculations on your own, determine on your own whether or not you believe this is an increase, a decrease, or if it's beneficial or if it's a drawback. Next up is liquidity ratios. This is the measure of the ability of a business to pay its current debts as they become due and to provide for unexpected needs of cash. So in order to, when businesses go into business themselves, chances are, more often than not, they are going to be running up debt. So when they run up debt, the liquidity within the organization will determine their ability or the strength of their ability to pay off that debt. Also another indicator of the strength of the business. So when it comes to liquidity ratios, again, the Investopedia video is going to be one that we are going to be watching in class next time we meet. Working capital is going to be one of the numbers that is going to help contribute to this particular ratio. That is what we are calculating. This means that the business has enough capital to continue operations. How do we determine our working capital? We take current assets and subtract from it our current liabilities. Now, current assets, these are used up or converted to cash during the normal accounting cycle. Assets, remember, all of our accounts in the 100 numbers. And our liabilities, which is all of our account numbers in the 200s, which is going to represent our debt or what we owe. This is the debts that must be paid within the next accounting cycle. So current assets minus current liabilities gives us our working capital. You want this to be a positive number, which means assets are greater than liabilities. If it's a negative number, that's not good. That shows there could be a potential issue in terms of the ability to pay off liabilities. All right, so let's take this and put it into an example. Working capital means that the business has enough capital to continue operations. Again, the calculation for working capital, current assets minus current liabilities. We want it to be a positive number. So let's take a look at this example. Roadrunner has a current assets of $22,575 and current liabilities of $11,725. What is their working capital? Go ahead and do the calculation. And is this a good or a bad relationship based off of these numbers? Okay, so go ahead and do that on your own. Make that determination on your own as well. And practice calculating working capital. Next up is the current ratio. Okay, also another one that is going to be represented on the Investopedia video. The current ratio indicates how well a business is able to pay its debts. Okay, so the current ratio is going to be current assets divided by current liabilities. High ratio is good. We want a 2-to-1 ratio or higher. Low ratio is bad, indicating possible difficulty in being able to pay our debts. That is the purpose of the current ratio. Let's take a look at an example. The current ratio is going to be how well the business is able to pay its debts. Again, review, current assets divided by current liabilities equals our current ratio, and we're looking for a result of 2-to-1 or higher. So in this case, Roadrunner has a current asset of $22,575, current liabilities of $11,725. Is it a positive relationship in terms of our current ratio? Do we have a 2-to-1 ratio or better? And is this, if not, or if we do, is this good or is this bad? Okay, so go ahead and do that calculation, practice that, and based off of what the current ratio is designed to represent, make a determination as to whether or not we have a good current ratio or a bad current ratio. The quick ratio. Again, also another one that is represented on the Investopedia video. The quick ratio indicates if a business can pay its current debts with cash from its incoming receivables. All right, so money that we owe versus money that is owed to us, and the relationship between that. So if we have current receivables divided by current liabilities, that's going to equal our quick ratio. We are looking for a ratio of 1-to-1, which is considered adequate. However, if we have more receivables coming in than debts to pay, that's even better yet. So the quick ratio, let's take a look at an example. If we have Roadrunner, which has current assets of $22,575, current liabilities $11,725, current cash balance is $21,125, and receivables are $1,450. The question is, what is the quick ratio, and do we have a good or a bad quick ratio at this point in time? The calculation for the quick ratio is taking cash and receivables divided by our current liabilities. Again, remembering that 1-to-1 is considered adequate. But if we have a higher ratio, that is better. And this concludes the presentation lecture on the different ratios in terms of analyzing financial statements and what these ratios mean. Please feel free to review this presentation lecture as much as possible in order to familiarize yourself with these different ratios and how they can impact the health of a business in terms of the numbers that are represented on our financial statements. And I will see you next time we meet in class.